This is the Build Wealth Canada Show, episode number 26.
Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell and welcome to the Build Wealth Canada Show. So I've been getting a ton of requests for an episode that talks about dividend investing in Canada. So a big thanks goes out to all the listeners who reached out and made the request by either leaving a review on iTunes or signing up to the free Build Wealth Canada newsletter and asking me in the comments section there after signing up. So based on all your requests, today I'm excited to have Ryan Modesto on the show, who is the dividend expert and managing partner over at 5i Research. And if you recognize the name, it might be because you saw him on TV over on the Business News Network, so BNN, or you might have read one of his many articles or analysis, as Ryan literally analyzes Canadian companies every day to find the best ones to invest in, especially if you are a dividend-focused investor. Now, if you're new to dividend investing, then don't worry. We're going to start off at the basics, build a good foundation, and then move our way over to some more advanced questions once we've got a good handle on things. Now, Ryan has also been generous in providing Build Wealth Canada listeners with a special offer where you can get your investing and dividend questions answered by him and learn other dividend investing best practices by getting a free trial membership over at 5i Research. So you can get the special link for the free trial by going to the show notes over at buildwealthcanada.ca/26. So just the number 26. All right, now let's get into the show. All right, Ryan, welcome to the show.
Thanks for having me.
So, Ryan, to kick things off, for those Canadians new to this type of investing style, can you explain what dividend investing actually is?
Well, I guess you need to kind of take a step back and make sure you understand what a dividend is in itself. So a dividend is a distribution that's paid by a company to the common shareholders. It's paid out of the company's cash flows after net income. And so the type of company that typically pays a dividend is kind of a more mature company. It's in the mature stage of their life cycle, and they have more stable and predictable cash flows. So the general kind of universe of a dividend company is kind of a safer, more established company. And I like dividends because they're essentially paying an investor to think long term. If you're sitting in the red on a company, it gives you justification to hold it just for a bit longer because it's paying dividend checks into your bank account every month or every quarter. And then you're also able to take those cash flows that a company's paying you and reinvest those dividends either into the company that's paying you those distributions or into another company. And the reinvesting of dividends over the long term is where the rubber really hits the road with dividend investing. And I'm sure a lot of your viewers and you have talked about this before, but it's kind of a similar concept to the compounding of returns or keeping your fees as low as possible, because maybe over a year it doesn't look like that much, but over 10, 20, 30 years, those amounts really add up.
Exactly, yeah. I think a lot of listeners are familiar with compound interest or just kind of if you've read any of the personal finance books, pretty much every one of them has a chapter on, most of them call it the magic of compound interest, right? And so this is kind of what you're saying. Yeah, it's a comparable thing. If you're taking those dividends and now, instead of spending them on something, you're actually reinvesting them to buy more. And then now that grows, and then now you get even more dividends because you've bought more using dividends, and then you just it just keeps snowballing, basically, right?
For sure. There's also actually, and dividends are also tax efficient relative to fixed income as well. You kind of get a dividend tax credit, so that's another kind of bonus with them.
For sure. Yeah, and I have a question lined up to to set you up to talk about that as well, because I know that's a really big thing as well, for sure. Especially specifically for us Canadians, that's something that I don't know how prevalent that is in other countries, but I know for sure in Canada we do have some pretty nice incentives from a taxation perspective as well. So that's great. So when should someone consider doing dividend investing? Is there a particular life stage when it's most appropriate, for example?
Yeah, I think there's kind of two schools of thought with this, and so the one is that if you're younger, you should be more of a growth-oriented investor. And typically a growth company isn't one that's going to kind of, how I was saying that some dividend companies are mature companies. That's not what you usually get in a growth company. They're still kind of finding their footing, growing their market, growing their revenues, things like that. And so the whole idea is that you're younger, you can take on more risk, and with that longer time frame, you can allow these higher risk companies to kind of build on their strategy and execute whatever strategy that you're investing in.
Hmm.
So you're not going to get that same kind of growth potential to grow your capital in a dividend pair. So with that, there's the thought that dividends suit a older investor or investor in later stages a bit better. But
Hmm.
the other side is that not everyone can or wants to take the time to find those higher risk growth companies. Sometimes people just want to collect a dividend check, and at the end of the day, you don't really need to be a genius to figure out that owning a company like Bell, BCE, or Royal Bank or Bank of Nova Scotia is a good idea, right? I mean, they've been paying dividends for numerous years. They've been growing the dividends, so it takes a lot of that risk and work out of it. So I think the answer is it's somewhere in the middle. Like the older you get, the more owning dividends makes sense. But I still think dividends should be part of pretty much anyone's portfolio.
Hmm. Yeah, because I think with well, like I invest in ETFs, right? And so broad market, low fee ETFs. And so when I do that, I mean, right now I'm a younger guy, right? So I go, that's my strategy. But one of the things but we have a lot of listeners actually on this show who are actually much older than I am, and they're maybe 60 or they're maybe 10 years away from retirement, let's say, and so what I wonder, and so I get a lot of questions about kind of asset decumulation and, when you kind of reach that level and, you're no longer focused on growth as much, you're now more focused on income. You want that cash flow coming in because now you're retired, right? So how common is this strategy of, okay, let's say, you're a dividend investor in the or not a dividend, an index investor in the beginning, you're letting your assets grow. And then, you get into that older, you get a bit older, you're getting closer to retirement, I don't know, maybe 10 years out, or you just hit retirement. And how common is it to then transition to, for example, be a dividend investor now, because now, your focus, your life is different now, you're retired. And so your focus is now shifting to income as opposed to growth.
It's if you're jumping from being an index like a pure passive investor to say owning a basket of 20 or 30 dividend stocks, that's a pretty big jump. So I don't know if
Hmm.
that's a comfort level issue, right? And especially if you're in retirement, you're going to be more concerned with stability and cash flows. So I think it would be, from a psychological point of view, it'd be very hard for someone who has for the last 30 years of their life has been a passive like ETF
Right.
type of investor to jump to owning a handful of individual dividend pairs. There's
Hmm.
merit in the strategy, but I think the minute you have say a 10% downturn in a market and maybe a few of those individual stocks get hit very hard, it could
Hmm.
cause some panic reactions and maybe
Okay.
some panic selling. But there are to that point, there's a lot of dividend paying high dividend ETFs that instead of holding maybe just the TSX composite, you could hold a high yield or a high dividend paying or dividend growth ETF and sort of
Okay.
just flip your holdings over to that to kind of help add a more steady income. And I mean, it makes sense. It definitely makes sense to transfer some of your holdings so you have more cash flow visibility in retirement.
Mm-hmm, mm-hmm. Yeah, I could see that. Yeah, if you have a portfolio, let's say, you're 60, your portfolio is $1 million. You've been doing, ETF index and broad market index investing your whole life, and then now it's like, all right, let's sell some of this and put it towards these, select companies. I could see that being very stressful,
Yeah, yeah. I mean, and
to say the
there's
least.
nothing wrong with it. Like I mean, someone could do it, but it's a different approach.
Mhm. For
Especially
sure.
if it's when it's different from something you've been doing for your whole life, kind of thing. It could be tough for
Gotcha.
a lot of investors to do.
Okay. Okay. Sounds good. So maybe a more suitable option for them is to consider switching over to more, like you said, sort of dividend paying, more dividend focused ETFs that
Yeah,
are still kind of, that still hold, a lot of companies. So it's still nice and broad. They're still getting that good diversification. They're not just investing in, 10 companies or whatever the case may
yeah.
be. But that's kind of more the comfort zone
For
since
sure.
they've been used to buying ETFs.
And
Okay.
then and
Yeah.
on
That makes
top of that, you could
sense.
always then just kind of pepper in higher dividend paying stocks that you're interested in, right? That you're
Right. Oh,
comfortable
that makes
with,
sense. Yeah.
and then that kind of helps elevate your your cash flows a bit more while not really taking on a whole lot more risk because you're holding those diversified baskets through the index funds.
Gotcha. So yeah, so instead of sort of talking about an extreme example, which is I guess what I propose, where you just move everything, like, so you wouldn't do that. You would just do, like you said, you just take a section of it, a piece of your portfolio, and say, okay, I'm going to keep these in ETFs, and then this other one, okay, let's focus on, maybe you'd still want a diversified portfolio of dividend paying stocks, but you're not kind of putting. You're still kind of sticking, your core is still what you're used to and comfortable with. You're just venturing out a little bit just to get that extra bit of income that you need now in retirement. That makes sense. Okay. Sounds good. Yeah, I was always curious about that whole kind of transition, from being sort of a growth focused investor when you're younger versus being a more, okay, now we actually need the cash.
Yeah.
what do we do, right? It's a big question.
And it should be a transition kind of thing, right? So once you're within say 3 years, maybe in 5 years to retirement, you slowly start kind of transferring a portion or a percentage of your portfolio to maybe a more stable dividend or a fixed income allocation. So, it doesn't have to be, okay, I turned 60, let's just sell everything and buy this new type of asset or new type of strategy. And you can ease yourself into it. And then as you're doing that, you'll also gain a comfort with what kind of risks and volatility you handle.
Yeah, and I can see that being a good time, when you're at that stage, especially to, you sit down with a fee-for-service financial planner, someone that's not incentivized to just sell you high-fee mutual funds, and you actually look at your situation saying, okay, I'm retiring, and whatever the case may be, it's actually it's coming. It's no longer 30 years out. What should I, what's a good, what are some options I should consider based on? Because I guess at that point it gets a lot more complicated too, because you've got you probably have other assets too, and tax considerations, and who knows what's going to happen by in terms of the government and benefits and all that. So so fair enough. No, that's great. And is there a type of person that is more suited for this type of investing? So, for example, in terms of the time they're willing to invest in it, or maybe, there's certain people with certain personalities that are maybe better suited for this type of investing than others. Can you maybe comment on that a bit?
I think it works for any type of investor, really. Like, if you're a passive investor, I think you're gonna like a dividend strategy or some sort of dividend portion of your portfolio, because it pays you to wait. You can kind of set it and forget it, hold some good companies with a good history of operations, and just kind of collect those dividend checks. It works on the active side because you can find names that are, say, maybe growing their dividends or are just starting their dividends. And the markets have a tougher job of pricing these kind of events in. You can kind of pick out dividend growth companies, but you don't necessarily know when they're going to increase that dividend. So active investors can find ways to maybe generate excess returns through dividend investings as well. But I think it suits investors best who are either impatient or they are very uncomfortable when they're holding a stock that's in the red, like that's losing the money currently, because it pays you to wait. Nobody likes losing money on a stock, but you have to accept that it's going to happen. So if you hold a good stock and it's paying you a dividend, but it's at a losing position, at least you're getting something in the bank account. And I think that can ease a lot of tensions that investor may feel when they're holding that security. It might just encourage them to think a bit longer term and not do a knee-jerk reaction when there's one bad quarter in the short term.
Right. Yeah, that makes a lot of sense, because for sure, I've definitely talked to people who, they kind of try the stock picking approach themselves. I'm sure you've talked to a ton of people like that too, and and the stock's in the red, and they're kind of, all right, I'm out. I'm not going to be doing it anymore. And like you said, just because the company maybe had a bad quarter, I guess it also depends how you made that decision to purchase that stock in the first place. Was it actually did you actually do the analysis? Are the fundamentals of the company still very strong? Is it still a good company and it just had a bad quarter, or something happened in the markets to make it go down, and so there's not really any good reason to sell it. But I could see, when like you said, when you see the red, there's that automatic human people just want to maybe drop it, right? Whereas if you have that money coming in, it makes it, you're like, well, at least I'm getting some income for it while I ride out the storm So it makes it a bit better. Yeah.
And then that's giving you kind of, as you were talking about earlier to it, that's giving you that extra cash flow that you can then reinvest, right? So if you
Right.
still like the stock at a lower price, you essentially have the ability now average down into the stock and purchase it at a lower price. Or
Exactly.
if you're just not totally comfortable with it and maybe there's a better opportunity you're seeing, you can just divert those dividends to another interesting opportunity.
Hmm. Yeah, that's great. Yeah, so if the fundamentals are still strong, but maybe you're not as confident anymore for whatever
Mhm.
reason, then yeah, like you said, you buy it. You maybe purchase another one that you're more interested in, or if you think, oh, this is great, it's a temporary drop, so now it's basically at a discount. I
Exactly.
think if that's your belief, then now you can kind of put that money in and buy more. So it could actually be good news for you depending on how you approach it and on your analysis.
For sure.
So yeah, no, that's great. What are the pros and cons of dividend investing, basically of this investing style versus something like index investing or mutual fund investing or stock picking, but specifically for growth?
Um,
And I know you can go on a big giant rant
yeah.
on mutual fund investing. So if you do want to do that, feel free.
I think that there's two clear cons with dividend investing, and that's just the time it takes to manage a portfolio, and then the concentration risks with investing in it. So say you're holding 10 to 20 dividend names, you run a risk of maybe one, two, who knows what's going on. Let's say five of those companies underperforming the market versus if you're just holding, say, a passive index or passive ETF. So you're taking on company specific risks if you're just a dividend investor, and you're also taking on kind of a style concentration risk as well if you're only focusing on dividend payers, because sometimes whether how good or how bad the dividend companies are, they go in and out of favor in the general markets. Over the long term, things kind of tend to work out if you're holding the right companies, but you can see you have to be comfortable with how things are going to turn out with the stocks.
Mhm.
Um, so the pros are kind of just the opposites of the cons, right? Depends on the type of person you are. It can be rewarding personally and financially, and it can be pretty easy to create a portfolio that has a higher yield than the TSX and potentially less risk too. Because when you look at the TSX, it holds primarily financials and energy companies, right? So you can now kind of tilt a dividend portfolio to other names that are less focused in those two sectors and improve your diversification while potentially having higher yields from companies like the telecommunications space and the utility space. Um, and you can also avoid the fees, right? So you could create a smaller portfolio of dividend stocks and avoid the high mutual fund fees that a lot of times are just closet indexing to the TSX anyways. And
Right.
even on the ETF side, I mean, you can argue how worthwhile saving say 0.5% on a fund is, but as we were talking about, any little bit adds up over the long term. So you can almost create a shadow ETF through dividend stocks and just forego all of the fees while getting kind of a similar exposure to
Mhm.
um, to what the index is going to be providing you.
Mhm.
Where else do I want to go with this? So stock picking, I guess. Um, Dividend investing really still is stock picking, right?
Right.
But there's kind of an interesting point to make here where dividend payers sort of act as a natural filter in investing. So instead of tearing out the financials, looking through the cash flows, the balance sheet, the income statement, all those kind of things, um, when you own a dividend payer, you know that, or you can be reasonably assured that, hey, they're generating positive cash flows because they're paying a dividend into my bank account. So there's cash somewhere and it's coming to me. So there's kind of a natural filter there. And there's also the fact that most companies that pay a dividend are more mature, stable companies that are profitable. So I mean, it's not there's always you're always going to get the frauds. You're always going to get companies that don't work out the way you think, but by owning dividend stocks only, you're actually increasing the quality of the investment universe you're looking at.
Mhm. Gotcha. And you mentioned, just kind of as an aside, you mentioned a little bit about how mutual funds, how they charge the fees, but a lot of them are primarily mimicking the index. Can you speak to that a little bit?
Yeah.
Because you use the term as well that I think maybe some listeners aren't familiar with.
Yeah. So closet indexing essentially is when mutual funds charge you, say, a 2%, 3% fee, and they're really just holding the funds the companies within say the TSX composite.
Right.
They're shadowing industry the industry weights, and they're shadowing the actual stock specific weights within those industries as well. And there's actually a study that was out recently. Unfortunately, I can't quote where it was from because I can't remember. But it was talking about closet indexing, how it's a really big issue in Canada. And it is tough for the Canadian managers because the Canadian investment universe it's smaller, right? So the we really are dominated by banks and energy companies, and there's only a certain number of companies that are large enough and liquid enough to support kind of that large investor base that would invest in a mutual fund. So when you compare it to like a S&P TSX 60 to the S&P 500, right?
Mhm.
So it's just the universe that a lot of Canadian fund managers have to choose from is smaller, and so by default, their hands
Right.
are a bit tied in the sense that a lot of them are going to end up in being closet indexers if they're following some sort of large cap mandate.
Mhm.
But there are things they could do to be a bit more creative or kind of take a bit more risk and actually earn the fees that they're charging.
Mhm.
But yeah, so that's the general idea of closet indexing, and it's I think it's a bigger issue in Canada than you would see it in other countries.
Mhm. Yeah, and I can just see a lot of Canadians getting frustrated, if they're paying, let's say, 2.5% for a mutual fund, and they were sort of sold on the fact that, it's gonna outperform the market, that they have these experts working, out of floor, in Toronto, and they're just analyzing the best things, and they're gonna beat the market for you, and all this fun stuff. And then when you actually dig into the details of what they're investing in, it's primarily the index anyway. So you're could have actually just bought a low cost ETF of the
Yeah.
index, paid like just a ridiculously low fee for that compared to what you're paying as a mutual fund, and basically, you could be getting the exact same performance. So that's just, yeah, I like to throw in these little questions just to, at least, because I get it, if you've been investing in mutual funds for 20 years, you've kind of have that momentum, and you maybe, it's hard to change behavior.
It is.
So I just like to throw in these questions so that if you fit into that, someone fits into that, they think, maybe what Ryan and Cornell are saying here is something I should consider. Like, maybe I should, basically, to question what you've been doing.
Yeah.
If that's all I'm kind of asking, is just, question a little bit, because some of these things are happening in the industry, but they're just so good at hiding it. And yeah, it's ripping a lot of Canadians off. So anyways, that's my little aside. I get a little frustrated at
That's fair.
I don't like Canadians kind of getting taken to the cleaners
Not,
because of some of
Neither
these
do
things.
we. So
Exactly. Yeah, exactly. So, anyways, all right. I digress. So, moving on. One of the things that I'm sure you've probably, a lot of people kind of have heard of, is kind of the idea of being able to live off the dividends, and that's, oftentimes, kind of, when you talk about dividend investing, that's the part that kind of jumps out as, oh wow, I can just invest and I'm living off the dividends. It's like a passive income stream. It's amazing, and it'd be great if I could just get enough of these dividend paying stocks so that the dividends fully fund my lifestyle, and I don't have to work. It's kind of the sort of like the the Canadian dream, I'll call it,
it is.
right?
Yeah.
Or a
Yeah.
modification of one. So how, let's maybe talk about that a little bit. How realistic is that, and what actually would be needed for a Canadian to pull something like this off?
So the answer really depends on what living comfortably is to you, right?
Right.
It's like
Right.
if you need 100K in retirement, then living off of a dividend stream is going to be pretty tough. But
Right.
if you think you can live off of say 30,000 in dividend income, and then you add in kind of your maybe you get a pension and then your CPP, you could easily get to, say, a 50,000 annual income off of 30,000 in dividends alone. And I think a lot of households could live a modest retirement off of 50,000 in total
For
annual
sure.
income. Just assuming no kids in the house paid off, no debt, all that kind of stuff. You're not going to be sipping fine wines and scotches and things like that, but
Right.
you're gonna have financial independence, which is awesome.
Right.
So how do you get there though? So right now the TSX yields about a 3.3% dividend yield on it. Um, so if you wanted to live off of just investing in the TSX composite and get that 3.3% dividend, you'd need about a $910,000 portfolio to get that 30,000 in dividend income. This is all before taxes. It's just easier to do that way. But
Right.
so it'd be a $910,000 portfolio. That's if you are a diligent saver, and have a decent kind of have had an okay career in your past, that's probably an achievable
Hmm.
target to have that size of a portfolio. But you'd have to be a diligent saver, and we all like to have fun. We all like to spend money. So, but if you're selective with your portfolio, and this is where that dividend specific portfolio can come in, right? I was talking about maybe shifting it away from just your financials and just your energy to some higher yielding sectors. So if you're selective with your portfolio, you can create kind of a large cap portfolio that, with relative ease, achieves a 4% yield. And if you're willing to just do a bit more work and a bit more research, you can probably structure a portfolio with an average 4.5% yield with, again, relative ease and not a whole lot of extra risk. So now you're looking at something like a $750,000 to a $650,000 portfolio to generate that 30,000 a year in dividend income. And I think that that's getting into the realm of reasonableness for what an average Canadian can achieve, like the
Yeah.
portfolio size an average Canadian could achieve in retirement. So I think that that's kind of what you would be looking at if you were seriously wanting to retire on dividend income.
Yeah, that's it actually, yeah, it really does sound very achievable. I mean, I've played quite extensively with, the different retirement calculators that are, available to us, and yeah, it's that's I think that's really, really good news, for sure. Because I mean, if your answer was, well, if you want that, it's, you need 3 million,
Yeah,
right? Then that's just, Canadians are just gonna say, okay, well, yeah, that's just not gonna happen. But I mean, it can for sure, right? But it's more, if we're talking kind of, typical, average Canadian, that's not something that people often think
yeah.
that they can just kind of do without easily do and still maintain their lifestyle. So that's really encouraging. Now, yeah, I'm trying to I'm trying to make this show a bit more friendly to beginner investors as well. So can you? And so I'm great that. So I like that we're going kind of into this detail. It's fantastic, and we should definitely keep doing it. But for somebody that's just starting off and doesn't know, like when you say yield, can you define what you mean by yield?
So yield is just the dividend you're getting over what you're paying.
Mhm.
So um, buy a stock. Say a stock's $10, it pays you a $1 dividend. You're getting a 10% yield there.
Sounds good. Perfect. Thank you.
Is that math right? Yeah,
I
yeah,
got, I got some questions because I know when you had I had that interview with Peter a while back, and we kind of just jumped right into it, right?
yeah.
And so I had one question from where you're saying like, Cornell, this is great. I'm really enjoying the interview here with Peter. It's wonderful, but you guys started talking about the ETFs, and I didn't even know what an ETF is, so I
Oh,
had to pause the episode. I had to go online, do some research, come back, and then now I could listen to the rest of the interview now that I know what the heck you guys are talking
and that's
about. So I'm trying to be good,
and it is tough, and that's one of the problems with financial industry in general. Is like, I mean, we do our best to keep things simple and not use jargon, but I mean, if you read
Sure.
a report or watch TV, it's full of jargon that sometimes I don't
It
even know
is.
what the heck people are talking about, kind of thing. So that's a good reminder, because sometimes it's something I deal with and do every day, right? So you kind of just get
Exactly.
into the flow of things, but um, yeah, yeah. So I definitely understand what you're saying, though.
So,
But
sounds good.
so
Yeah.
on the yield, the a lot of people, actually, we get a lot of questions about this. The dividend stays constant, or the dividend the company sets stays constant. So dividend will come and say, okay, we are going to pay $1 dividend annually. So That's the dividend you're going to get. But the yield is what changes because it changes on the price of the stock. So if the stock price goes down, your yield has increased because you're getting that same dividend on a lower stock price.
That's great. Perfect. Yeah, thanks for clearing that
Yeah.
up. Yeah, I definitely want to make the show accessible for the medium and advanced investor, but also kind of for the beginner that's just getting started. Because yeah, like you said, there's a lot of jargon out there. So figure it doesn't hurt to get some definitions out of the way maybe as well. But no, I think you defined that really, really well. I think that that's something everyone can understand.
You
So
think there too.
thank you.
Sometimes the really simple stuff you kind of just stop thinking about, right? So you have to go back and think like, what is that calculation?
Exactly. And I apologize for asking you
No,
to do math on the spot. I know that's always I know that's something I try not to do to the guests. But okay, no, so that's great. So next question I had for you is, really, what are some of the top mistakes Canadians make when it comes to being dividend investors, investing for dividends?
so one of them is assuming that dividends are safe.
Hmm.
Dividends are not fixed income. Um, they are paid at the discretion of management. So at any day, any time, a management team at a company could just say, you know what, I'm not really feeling the dividend anymore. Let's just cancel it.
Hmm.
There's nothing that is stopping them from doing that. So so while in general you can have some assurance that a company will do all it can to maintain a dividend because stocks get punished when they cancel a dividend. Nobody wants to see their share prices go down. But when things are bad, usually the dividend will be the first thing to go. So that's kind of why it's important to, if you are relying on the cash flows, you really want to make sure that you're investing in kind of operationally sound companies that have a history of paying the dividend,
Hmm.
so there's less likelihood of canceling it. But even the big banks in 2008, even they canceled their dividends when they were going through a tough time.
Hmm.
They're paying them again, they're increasing them again, so it's kind of all is good. But even the companies you would least expect to do something like that can do it.
Hmm.
Um, the second would be investing only in dividend stocks. Uh, Dividend stocks are great. They over the long term they do well. All the things we've been talking about. You can reinvest them. You get great compounding returns, and it's nice to get that cash flow in your bank account. But as you're saying, investment styles go in and out of favor. So diversification is key so that you can benefit in the good times and the bad times. Maybe for a year or two, people will be more interested in growth stocks. So if you own a bit of growth, your portfolio will be benefiting on the growth side while maybe your dividends are floundering. But then maybe 2 years later, the situation reverses, and and then if you're rebalancing over this period as well, where you say growth has done well, you take some of those gains, invest it into the underperforming dividend stocks, and then that situation reverses, you're averaging up your portfolio over that scenario. That's getting a bit advanced, but just I would take it back to dividend stocks are great, but you don't want to be 100% in dividend only companies because that does add concentration risks.
Gotcha.
And so the other big one is just chasing yield. Often, especially you see a lot of them in the Canadian markets. There's those nice juicy 6%, 10% dividend yield type of companies, and that looks great. But more often than not, that should be viewed as a red flag. The markets aren't are very the markets are very smart. They can price a lot of securities well a lot of the time. Sometimes there's issues, sometimes they make a mistake kind of thing. But in general, and especially with those high yielding dividend stocks, they're on to something, and the markets are trying to tell you that this company's paying you we're it's paying you a 10% dividend because that's the only reason I'm willing to own it, is because I need
Okay.
10% in the income alone, right? So
Mhm.
the markets are afraid that there's going to be a dividend cut, or there's just maybe they hold a lot of debt, and they just don't have that financial flexibility to grow anymore. And so again, the dividend is at risk, or something else is at risk. So chasing yield I think is one of the biggest issues you see amongst dividend stocks, especially with Canadian investors. If there's a high yield, it's usually high for a reason. So just watch out.
Mhm. That's great. Yeah, I was definitely waiting for you to say chasing yield, because because it's so tempting, right? Especially when you see some of these articles and reports, and you see like, wow, look at the dividend this thing's throwing out. This is amazing. Why don't I just, if they're releasing this high, if they're issuing such a high dividend, they must be doing great as a company,
Yeah,
right? And so let's buy it. And yeah, but like you said, it's not that necessarily the case. So I'm glad you mentioned that, just so that, because yeah, that temptation is there, and if you don't kind of have that warning
yeah,
as to what's really happening, you can make some pretty big financial mistakes.
sure.
So thanks for saying that. And yeah, and I like how you said, how it's not a guarantee. It's not, buying a government
No,
bond or something. It's and like you said, I mean, a company can change its strategy. It may, before maybe it was sustaining, now they're going to be doing some growth, some development. They're now going to be reinvesting that money into growing their infrastructure, or whatever the case may be,
yeah,
as opposed to releasing it as a dividend. And you can't really control that as a shareholder unless unless you own a lot of that company.
yeah.
So that's great. So at 5i, one of the things I noticed you guys do is that you guys have sections of the site that are dedicated specifically for dividend investors. And I noticed that in there, you recommend primarily Canadian companies. And we already talked a little bit about that preferential tax treatment of dividends. So I imagine that's one of the reasons that you guys focus, a lot on Canadian companies when it comes to dividends. Is that the reason? Are there other reasons that you do it as well?
We do it for a lot of the reasons we've kind of talked about just
Mhm.
throughout this conversation we've been having. So the one is that it's easier to hold a company over the long term if it's paying you a dividend, right? And so every company we're looking at, we're thinking a 3 to 5 year holding period, because we're thinking longer term. We don't really care about the next quarter. They can, as long as, I mean, their their target market hasn't disappeared, kind of thing, we're okay with a quarterly miss. So when you have those kind of shorter term issues, a dividend really helps an investor kind of hold on to it, and be happy that, hey, at least I'm getting a dividend check at the end of the day. The quality side of it is another thing, where a lot of times dividend payers, they have a proven source of cash flow, and that's proven out by a history of the dividend. But what will I mean, not all of our, probably we have a growth tilt to the companies we cover, but a lot of those growth companies also, we do like it when they have a dividend, but we don't rule out a company just because it doesn't pay a dividend. I think sometimes you have a lot of investors that will only own dividend stocks, and by doing that, you limit some interesting investment opportunities out there.
Mhm.
Um, and what we are really looking for on the dividend side with the companies we cover are either companies who have initiated their first dividend ever, because that's a pretty big statement, saying, hey, look, we have reached a stage in our growth where we know we're going to have X amount of cash flows coming in, so we can pay a dividend out to investors. We can reward you. There's a good outlook at the company, and we have a more stable or maturing business now, so we can afford to pay you a dividend. And then the other one is just dividend growth companies that we're looking for. So a company that is consistently raising that dividend and rewarding you not just with the cash flow to your bank account, but rewarding you with a higher cash flow and potentially a higher share price as that yield increases.
Great. And then, so for somebody that wants to maybe, dabble into dividend investing, would you say that, would you recommend that they stick to Canadian companies as well, just because, well, one, because you guys cover them, and so they will have some extra sort of support and analysis
Mhm.
to help them with their decision, whether they decide to do it or not. But then two, kind of because of the sort of the preferential tax treatment in Canada of dividends, is that, yeah, can you maybe speak to that? Is that another kind of big consideration if someone wants to maybe invest in a few, or maybe try to follow one of the portfolios you guys have for your members? Is generally sticking with sort of the Canadian companies, is that good enough, or is, as long as you're doing other things as well? Yeah, what are your thoughts on that?
Yeah, it's sort of, I mean, there's a tax, you get into tax issues, right? When you're looking at international companies and dividends. I mean,
Mhm, exactly.
if you're going to hold a US dividend payer, you'd probably want to hold it in your RRSP, because that's there's tax treaties where it's recognized and you get the same tax benefit you would in Canada. But once when you start holding it outside of a RRSP, like an international company, you get into more issues. So most a Canadian investor would probably want a big chunk of their dividend portfolio to be on the Canadian side. And we actually offer, like, we have an income portfolio that we offer our members, and it targets a 4% to a 5% portfolio yield. And so it's a mix of individual equities, like individual stocks. And then we also have some fixed income ETFs and things like that in it. So it's not, I mean, our kind of goal with it was, we don't think we're going to add a whole lot of value if we're telling you to go out and buy Bell, Royal Bank, CP Rail, all those kind of big dividend stalwarts that everybody knows about, right? So we're looking at things that are a bit higher risk, but we're still comfortable with saying the total portfolio should pay you a relatively reliable 4% to 5% yield. So higher dividend yielders, then mixed in with some fixed income holdings to kind of offset some of those risks. And then on top of that, if people have any questions on, hey, is this, this 10% yielding stock safe, or what's the payout ratio on a company? We actually have a Q&A service where within about 48 hours, usually within 48 hours, we can have a response to you about any question you might have.
Yeah, that's awesome. Yeah, and I know with you guys as well, with To Build with Canada listeners specifically. Well, I'll talk about that a bit later, about how you guys offered the free trial, and that even as part of the free trial, they can also ask a question about this as well. So it's pretty. So I think it's nice of you guys to be able to be willing to offer that to the listeners, so that if someone's not, they're not sure, but they want to ask a question, they kind of have that option. So.
Yeah.
So thanks for that. And speaking of listeners, I did get some questions as well from listeners of the show. So the first question that I got here was from Tony, and he saw the interview I did with Peter, your colleague at 5i, and he was saying that, okay, well, in that interview with Peter was talking about how you guys like to invest in companies that are growing their dividend. And he said, okay, well, if somebody's researching a company themselves, it sounds like he wants to actually, just do some of this research himself. How can you check if a company is in fact growing its dividend? How would you go about doing that research?
Okay, this is going to get a bit detailed, so because it's not necessarily an easy process. Like, it's not difficult, but there's some steps to it, kind of thing. So you'll have to bear with me here.
Sure.
So if you want to find a dividend grower, the first resource you're going to want to use is called sedar.com. It's SEDAR, and that's just a financial statement depository where every public company has to post their financials in. So you can search whatever company you're looking for at sedar.com. And so you're going to want to pull up the annual financial statements or the interim financial statements and look at the cash flow statement. And you're going to want to go down to the lower third of the cash flow statement and look for an area called cash flows used in financing activities. And then maybe just on a piece of paper or a spreadsheet, record the cash dividends that are paid. There'll be a line item that says cash dividends paid, something like that. So just over whatever period you want to know, if it's over just a 1 year period, like over the 4 quarters, record it. If it's over, usually if you want to get a good sense of how much a dividend's growing, you're going to want to look at probably a 5-year time frame. So you'll probably want to look at the annual financial statements in 5 years worth of those dividends. So then in that same financial statement, you'll probably want to scroll up one page to a statement called the statement of changes in equity, and you're going to want to record the shares outstanding for each of those same periods that you've recorded the dividend amount paid. And then what are you going to want to do? You're going to want to divide that dividend by the share.
I think at this point, Ryan, he's just gonna go and ask you guys a question on your forum.
Just ask us a question. We'll do it for you in a couple minutes, kind of thing. but it's almost
That's why I was laughing before. I wasn't trying to be rude, but I could just see, at least, people that I've talked to, like, smart people, right? But still, it's like, okay, this is a lot.
yeah.
So
I,
I don't know.
I
Yeah.
I do have some quicker tricks. So I'll
Okay.
finish. There's two more steps here. So
Yeah, no, please finish. Sorry, yeah, I didn't want to. I thought, yeah, I think most people would be like, all right, I'm just
everyone's
gonna see what
falling asleep.
Ryan wrote in his like thorough analysis of the company, and then decide whether I agree or if I want to
Yeah,
invest or not.
that's fair.
So that's great. But no, but please continue. Sorry to interrupt. I just wanted to explain why I was laughing because I think,
That's fair.
some people
And
were
it,
like, all right,
and it
this is a
sounds
lot.
complicated when you do it kind of
Yeah.
spoken word or whatever. It's not as complicated as it really is. You're just pulling numbers from
Right.
financial statements, right? It's just
Yeah.
knowing what numbers to pull.
What to pull
So then,
the look.
so you're
Yeah.
dividing the dividend by the outstanding shares in those periods, and that gives you the dividends per share. Um, and then you can see, then you just calculate the growth of those dividends per share over those years, and that's how you can tell if it's growing.
Mhm.
Other tricks is that some companies may just post their dividends per share on their website, so you can look at it that way. But that's not all companies do that. Another trick is to look at the payout ratio. So the lower the payout ratio is, it's not insurance that it's going to grow, but if it's a low payout, there's at least room for the company to grow it if it wants. And then you can also look at, in a financial, company usually has something like what's called the target payout ratio. So if you can find a company with a payout ratio below the target payout ratio, there may be some likelihood that at some point in the nearer term they will increase that dividend. Or you could just ask us the question. We'll do our best to help you with
Sounds good.
it.
Awesome. Thanks, Ryan. That's great. So another question that I received, and you've answered this a little bit already, was what are some good resources for somebody that is considering or wants to learn how to do dividend investing? So you already mentioned the one site, and if there's others, feel free to let the listeners know. And I know you guys also offer a lot of help on this to 5i subscribers. So also at the same time, feel free to talk about some of the resources you guys have available for investors as well.
All right. Well, so there's a lot of blogs out there that cover, because dividends are really popular in Canada. So there's a lot of blogs out there that are covering kind of maybe their personal dividend strategy, living off dividends, or things like that, kind of their journey to financial independence, whatever. So there's a lot of those kind of free blog resources. A lot of them are good. Some of them maybe aren't giving the right information, but they're all good for at least giving a viewer insight into different ways you can look at dividend investing or different strategies you could consider. But I just wouldn't take anything as gospel that you read there. But definitely, there's very good ideas and strategies that a reader or viewer can read from these. On our side, on the 5i research side, we do formally cover Canadian companies. So we about a 3-page report, and we try to keep things worded simple, no, kind of as we were talking about, no jargon, things like that. So kind of your everyday investor should be able to pull up a report and get a pretty good idea of what a company's about and what its financial situation is about. We offer, it's like in each report we have a thing called a report card. And it just shows kind of the financial metrics that we think are important, are the things to focus in on, and we give a letter grade rating to it. So it's an A, B, C, D, maybe it's an F kind of thing. I was talking about the income portfolio, so that the income portfolio would really resonate with kind of the dividend type of audience, but we do have a growth and we just call it balanced equity portfolio, and all of those have some semblance of dividend names in it. And so we have a lot of members who, some will follow a portfolio outright, and others will just maybe pick and choose the stocks they like, but it's totally up to them. There's no, we don't manage money, or you don't have to buy into the model portfolio itself. It's just sort of take it as you want and use it however you'd like. And then the Q&A service is the final kind of value add for people where even, I mean, we get questions ranging from beginner who's just opening their first brokerage account to an advanced investor who is getting into cash flow statements with us and things like that, and we do our best to answer and help with any questions or issues regarding investing.
Awesome. No, that's great. Thanks, Ryan. And can you tell us a bit more as well about the free trial that you're willing to give to Looking At subscribers, as well as we already mentioned kind of the question that they can ask as well for free without having to subscribe or
Yep.
enter any credit card information, nothing like that. It's just a kind of a freebie you're giving away. And at the same time, where can listeners learn more from you as well?
Yep. So the offer, it's 1 month free subscription to 5i Research, and you do get a question credit with that, so you can kind of test out our Q&A system and see if that adds value for you or not. And it's full access, so we're not really holding anything back. We're pretty confident in the service being provided, and we're confident that as long as people give it a chance and try it out, that they'll come back after that month. So that's why we're happy to give that to you and to your viewers. And so if you want to learn more, you can just go to 5iresearch.ca. We do have a free blog you can sign up for and follow, where you just kind of get some insights and thoughts on the markets and interesting reading, things like that. And we do, if you have any further questions, we do have an email. You can contact us at info@5iresearch.ca.
All right, that's awesome, Ryan. Thanks. And actually, I just at the same time, I want to make it kind of extra clear that you guys don't actually sell investments. So you don't, and that's one of the reasons I thought it'd be great for us to partner with you guys, is just because you're conflict free. So you're not trying to sell Canadians some investments and then collect a commission or whatever, or some sort of extra fee from that now gets taken off the returns, and now the returns are lower because you're taking it. So you guys just you do. Well, I should let you explain, but my understanding, I know from kind of researching you guys very thoroughly, is that you do the research, you do the work, you do the analysis, and then you say, okay, based on our findings, which is like decades and decades of investing experience. Like Peter has over 30 years of experience, all to him, like just him alone, and it's not just him, right? So, and then you guys make this is what you guys feel comfortable kind of recommending, what you guys would buy if you were buying, but there's no conflict. So I don't know, maybe you can speak about that. You can probably explain it better than me.
Yeah. So we're a conflict-free investment research service, and it's funny when you kind of go through and look at these type of services, things like that. There's a lot of people who say that they're conflict-free, and I mean, they're not lying that they are, but I think we, like 5i Research, is the one company that can truly say we are conflict-free. We don't get money for covering any reports. Like, we don't have the companies paying us to cover a report. We don't have an asset management group that's, we're not trying to bring all of your assets into our company so we can manage that and get a fee from there. We really just run on the annual membership fee that members pay us. And on the no conflict side, we only formally cover Canadian companies, and we own no individual Canadian stocks ourselves. So we are investing in the US side just to ensure that, if we're saying a stock's good or bad, we don't have some sort of behind the scenes benefit that you may not know about. And that's what I mean when we're truly conflict free, is that we're just trying to benefit the membership. If we can help out, make our members learn something, or make our members make a bit more money, then they'll come back to us and they'll be a loyal member at that point.
Awesome. Yeah. And just so I understand, my understanding is that you guys won't actually hold those stocks, because if, for example, let's say you did, then there's now a conflict of interest, because you could say, you could theoretically tell people, okay, well, this is a horrible stock now, you shouldn't buy it anymore, sell it, and then people sell it. If enough people did that, it could actually impact the stock price, and now you guys kind of buy it up, or vice versa, I suppose, right? Is that sort of the logic behind that?
Yeah, and so what in theory you could do, right, is you could build a position ahead of time in a company and then say, hey, this company's great, go buy it, and then it increases the share price, and we benefit from that. So, I mean, obviously, it's a bit of a gray area for some, I guess, but there's nothing wrong with that necessarily, as long as the company you're talking about is still good. Right. But there is a conflict there, and we avoid that conflict by taking the approach that we've taken.
Exactly, right. Because someone could just say, well, you told us to buy this, but a month before you told us to buy this, you bought $500,000 worth of stock for that company. Yeah. And now you're telling all your members to buy it, and now the price is going up, and then you guys can just sell and then just make a quick buck. So you guys kind of avoid that. Even the opportunity for that to happen altogether, you just completely avoid it. You say we're not holding anything, so it's just fully you're totally kind of impartial, no conflict of interest, that kind of thing.
We do.
So that's awesome.
Just to be clear, we do own ETFs. Like we have the ability to own ETFs and mutual funds, things like that. But
okay, gotcha. No, that sounds good. Yeah, and if the Build Canada subscribers, listeners to the show, if you do want to get the trial, you just go to buildwealthcanada.ca/trial, and like what Ryan was saying, you basically get a month. You get to the membership, you get full access. You don't need to enter your credit card or anything like that. You just basically, you get full access. You can see all the model portfolios there. You can see, how they're rating the different companies. Last night on your website, you were saying it had 28,000 questions already that have been asked and answered.
It's up to 42,000 now.
42,000, awesome.
And it's searchable by the, we have a ticker database. You can search the company and you can get all the history of it that you can pull up.
That's awesome. Yeah. I was on it the other day and I went to the ETF tag because I invest in ETFs. So I was, I clicked to that and kind of saw other questions other people were having. Yeah. And so it's kind of nice too, because you get to learn from others' questions as well. And it's kind of a no pressure offer as well, right? Because, you try their free trial, you get full access, you get a free question. So you don't really lose there. Yeah. And if you like it, awesome. You can subscribe and then you get, I believe it's 24 questions a year, right? If you're an actual paid member, and you maintain your access. And if you don't, then at the very least you learned a lot because you got to ask the question, you got to view the tens and tens of thousands of questions that you had access to, and you kind of get to learn a bit about how to analyze stocks as well. So, and you can ask the ETF questions as well, right? So even if you're a broad market, I noticed that if you're a broad market, the kind of index investor, you can do that as well. Do you have any tip when someone asks a question? Do you have any sort of tips as to how to do it? Because from when I was there, it seems like you should definitely be kind of specific, right? Because you're not gonna write them like a like a 30-page kind of answer, right?
I think the key is to keep the scope in mind, right? It's kind of it's a question and answer. Think about if you were at maybe a conference and there's some speaker, you wanted to ask them a quick question, kind of that type of parlay or whatever. So usually we prefer one question, one answer type of questions versus here's 30 stocks I'm interested in. What do you think of them?
Of each one. Can you give me
Try to stay away from the personal portfolio situation. So when people start getting into I'm this old, here's my tax situation, and this and that, and then what do you feel about this stock? That gets tougher for us to do. So keep it more as what do you think of this stock, or what is going on with this metric at this company or this ETF, something like that.
Gotcha. Awesome. Yeah, because I know we have quite a few index, ETF investors listening to the show as well. And then the common question I get is, okay, so there's a lot of ETFs now, a lot of stocks out there too. What do I buy? I'm debating between this one and this one, for example. So you guys can actually go in and say, okay, well, we recommend this one because of this and this reason, that this is what we would buy, and then you can decide for yourself whether that's something that you'd like to do or not.
Yeah. Basically. Yeah. So comparison questions work well. Like, even if here's 3 ones, what do you like best? That's easy for us to do. But if it's something like I'm an ETF investor, what's the best ETF to own? That's tougher, right? Because there isn't necessarily, depending on who you are, what you're looking for, there isn't a one simple answer to something like that. So
exactly. All right, awesome, Ryan. Well, thanks so much for coming on the show.
Thanks for having me. It was fun.
All right, take care. Bye. All right, I hope you enjoyed the interview with Ryan. Remember to go to buildwealthcanada.ca/26, so just the number 26, for your free gift from 5i Research, where you can get the free trial and get more of your dividend and investing questions answered by Ryan himself. All right, so I'll see you over at buildwealthcanada.ca, and have a wonderful week. Take care. Bye.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.